Hi, Tom Simcox with Dave Nations of the Nations Group at Keller Williams Realty. As your real estate advocates, we don't just want to help you through your transaction, we want to be your economist of choice. And that means explaining the market, explaining what's going on and opportunities in our city, and we try and do that through making these short videos each month.
And this month's video is going to be about how strong the local market is and what does that mean for our buyers, our sellers, and our renters. It's going to be a little bit number heavy, but stick with us as we get through it and you'll have a great understanding of what's going on in the St. Louis market by the end of the video.
So Dave, we have an influx of buyers, we have extremely low inventory, and we have homes that are sometimes selling over a weekend with multiple offers, over listing price. What's going on?
Well, you're exactly right. What's going on is affordability. Homes are more affordable now than they have been in decades. We're seeing the prices have recovered since the crash, and we're seeing a lot more buyers out on the market right now.
Okay, so that was a pretty simple answer to a complex situation. So we're going to break it down for you, starting with affordability. In this situation, we're defining affordability as the percentage of income of an individual or family which is spent on their home's principal and interest payments.
Historically, 21.6% of income would be spent on affording a home. In 2016, we're only spending an average of 15% on our homes. When we look at this chart, that goes back to 1970. We see that affordability from year to year can change dramatically.
Okay, so we said back in our January video blog that home prices are going up. So how are they more affordable?
Interest rates. Interest rates are at historical lows since the recession, and that is keeping payments way down in comparison to the overall average.
Yeah, and we in the industry, we've been celebrating these low interest rates and quite frankly holding our breath for the last 2 years thinking that the Fed was going to increase the interest rates at any time. That's because the Fed wants to raise the interest rates and the cost of money. They've said that, and you can see just over the last year that they've tried several times. However, with oil prices down and the stock market slipping, the Fed may very likely have their hands tied, and we could very likely have at least another year to take advantage of these low interest rates and high affordability.
Let's put this into perspective now with two homes side by side. An average home in 1995 and an average house from 2015 with price adjusted for inflation. While the adjusted home price of the 1995 home is lower, in fact over $44,000 lower once adjusted, the monthly payment is still higher for the 1995 home because of the higher mortgage rates.
Okay, so if you're a seller, it's a great time to sell because there's so many buyers. And if you're a buyer, it's a great time to buy because low interest rates means that you're going to have relatively low monthly payments. What does this mean for our renters?
Well, last year rents increased 4%, while homes appreciated at a value from 5 to 6%. So what that means is that our renters' cost is going up and the homeowners are building equity.
Okay, so if you were going to compare your monthly rent to a home payment, what could you afford? Here's some examples. Based on a 30-year fixed mortgage with 5% down and a 4.5% interest rate, a home with $600 in rent means that you could get a home up to $90,000. $800 in rent would get you a home worth $120,000. $1,000 in rent would get you a home worth $150,000, and so on and so on. Thanks again for following our monthly video blog. If you'd like to see more, check out our Facebook page or visit us at www.tngstl.com.
And if there's a real estate topic you'd like to know more about, leave us a comment or give us a call at 314-775-2777. Thank you.